Guys, it is time for the Friday wrap. A couple of weeks ago, I gave you a few choices as to what do you want to know about, and today's topic was a super close second to last week's one. The CGT consequences of selling an inherited asset. Let's get into it. Let's have a look. All right, the general advice warning, don't run away and take action based on something you hear me say. Call me and we'll talk about you and your specific circumstance. All right, before we talk about CGT on inherited assets, let's just talk about capital gains tax and what it actually is. Basically, if you sell an asset, which is subject to capital gains tax, and make a profit, you are going to pay tax on that gain. There are some assets that are exempt from tax and there are some assets that are subject to capital gains tax. CGT assets like an investment property, investments in shares, managed funds, cryptocurrency. A lot of people think that they don't have to pay tax on crypto until they actually take the money out. No, if you transact and trade, that's a CGT event. Collectibles over $500. Okay, so if you sell one of these assets and have made money on it, you are going to pay capital gains tax on the gain. What about assets that are exempt from the CGT? Assets you purchased before 20th of September 1985. Why that date, do you ask? Well, that's the date that CGT came into existence. I was too young. I was 5 years old. I don't know who the government was, but they decided that we needed another tax if we made a gain on an asset, such as an investment property, shares, managed funds, whatever it was over in this column, that we're going to pay tax on it. So anything held prior to that date, exempt from the tax. Anything bought after that date, subject to the tax. Your main home, your principal place of residence, is exempt from CGT. Your car, your motorbike, and personal use items are also CGT exempt. Let's have a look at how it works. Let's say if you bought an asset, in this example, $50,000 worth of shares in the year 2010 and sold them for $80,000 in the year 2022. I'd hope that you made a bit more than that, but let's just run with it. You've made $30,000. Now, as you can see here, if you hold an asset for greater than 12 months, you don't pay the full tax. You get a 50% CGT discount. So half of the gain gets wiped away and the other half gets added to your taxable income. So in this example, 80 minus 50 is $30,000. We made $30,000. We held it for greater than 12 months, which means $15,000 is washed away. $15,000 gets added to our taxable income. Depending where we sit, if our taxable income is in these ranges, we'll pay this much tax on our $30,000 gain. Keep in mind these ranges. I'm going to come back to that with the $100 question. Going to make you work for it this week. All right, what about if we inherit an asset? Let's start with our parents' home. As I've already told you, your principal place of residence is exempt from CGT. But what if you inherit your parents' principal place of residence? It will keep its main resident exemption for 2 years, okay? Even if you receive it and rent it out, it's exempt for CGT for a period of 2 years. So you will then be able to sell that property within the 2 years and you won't pay any tax on it, okay? Happy days. If you decide to move into that property, it will then keep its main residence exemption because it's now your main residence. Excuse me. What about if we inherited an investment property? The rules depend on when it was purchased. As we said before, anything purchased before 20 September 1985 is exempt from CGT. So if you inherit an investment property that was purchased before that date, then the cost base of which you inherit the property at is the date or the value on the date of, say it was your parents' property, the date that they died, okay? So it's exempt from CGT all the way up to that, and then it changes hands on the day that they pass away. That is the date that we work out the value for you. So if you then sold it, let's say they bought it for $100,000 in 1980 and it's worth $1 million, you didn't make 900 grand. You inherited that property at the value at the date that you received or the day they passed away, which is $1 million. So then if you hang on to it and sell it down the track, $1 million is the cost that you put into your calculation. If it was purchased after 1985, it's different. It's the opposite. The cost is the price of the property. So if they bought the property for $100,000 in the year 1990, and then you receive it when they pass away, it's worth $1 million, well, you are going to make $900,000, okay? CGT discounts, everything like that will apply, but you inherit the property at the price at which they paid for it. So they're pretty important. Before 85, which is a lot less common now because it's so long ago, it's the date at which they passed away. Post 85, which is the most common forms that we see, is the date that, or the value or the purchase price, what they paid for it. So that's the same for shares. Okay, so if you inherited a share portfolio, same thing. Same, but different, if that makes sense. Can become complicated if the inherited property was their main residence for parts and not, or if it was improvements done and things like that. But I don't want to get into that at the moment. I just want to explain the finer details, and I hope that has made sense. All right, let's go back to this one. $100 question. I do love giving away $100 each week. I want to know the range of income, taxable income, that would be attributable to you paying 34.5% tax. Okay, I'll give you a hint. Jump on a website called taxcalc.com.au. I use it daily to show examples to clients. The ranges are all in there. Tell me what the brackets are: 0 to 20,000 tax free, 20 to 45, all that sort of stuff. I want to know what's the marginal tax rate attributable to that. You know what I mean? All right, guys, happy Friday. Hope you have a great weekend. Getting close to Christmas, couple of weeks left. Be good. Talk soon.